All right, welcome to Benny and the Squirrel. We are very honored to have Brent Donnelly, president of Spectra Markets, here today and author of the new Alpha Trader 2. Welcome to Benny and the Squirrel, Brent.
Thank you very much. I'm a fan of both of y'all's work, so I'm glad to be on. And it's unfortunate or good timing, I'm not sure, because the book comes out in like 2 weeks. So it's probably better to do a podcast when the book's out, but people can get it in a couple of weeks.
It's coming to an Amazon near you.
Absolutely.
So let's get it going. Rupert was excited you were coming on, and he wanted to talk about FX and FX vol. And maybe we start off with you're a trader like me. And so, you're like, hey, where's going on? What's mechanical? And I appreciate that. But I thought we start off with the dollar just because it's so important for everything. What's your thoughts on the dollar? Rupert's a bear. I'm a bull. Where you stand on that.
Let's make very clear. I mean, it's a time frame thing. I mean, I
agree. But just because we're going to get into some more stuff, I just want to start with that as
I mean, that's a good place to start. It's interesting that one person is bullish and one is bearish, because honestly, right now we're kind of in one of these crosswinds periods. And as newsletter writer, podcast goer honor, what you really want is the massive directional call that euro's going to 150 or euro's going to 0.8 or whatever. But you guys know my stuff. I don't always work like that. I mean, a lot of times there's just a mixture of things. And right now it's there's two massive forces, right? So one of them is rate differentials, which is pretty negative for the dollar overall, because the Fed is locked in this situation where they're not going to hike regardless of what oil's doing, whereas central banks like Norway and the RBA have already hiked, and the ECB will probably hike in response to the oil shock. So rate differentials are kind of screaming lower dollar. And then there's some other bits that are lower dollar, like Asian FX policies kind of supports a lower dollar as well. Like China's been fixing lower, MOF intervening in dollar yen, etc. But then on the other side of the coin, the real trade, the big down dollar trades usually come when investing in the rest of the world is more attractive than investing in the US. And we've had some phases of that recently, and the dollar went down pretty aggressively. But then if you look recently, because the AI CapEx trade is back so much and the semis and all that, if you look at, something simple like the DAX to QQQ ratio or whatever ratio you want to look at, or US versus rest of world, the US is outperforming pretty major to a major extent in the last month and a bit. So the rebirth of the AI CapEx trade is bullish dollar. And then the kind of rate differential story is bearish dollar. So I think what would unlock the dollar upside, and I think this is an interesting theme to, there's the themes and the narratives that are going on now. And then there's okay, what scenarios can I imagine that are realistic, but are not really priced in? And I think the big one is that the Fed blinks, or even if the Fed doesn't blink, the market pricing blinks and they start pricing in rate hikes from the US. And then the dollar is just going to absolutely moon in that case, because that's really what's been holding back the dollar, despite a lot of tech flows because of the rebirth of AI CapEx. So right now, I think we're kind of locked in this stalemate. And what you're seeing are cyclical currencies like Aussie and Brazil, and anything with carry are doing well, like Hungary, obviously, that's idiosyncratic. But then Euro, Swiss, and more funding type of currencies in yen are not appreciating really, because it's not the kind of environment where, with S&Ps making new all-time highs and US exceptionalism basically is back. Those aren't the kind of environments where you're going to make money short dollar yen or short dollar Swiss. So all that to say, you got to pick your, choose your fighter kind of thing. And in this environment, it's certain pockets of Asia, and then anything with carry are the trades, I think, short dollars. And if you're bullish dollar, then short euro or long dollar Swiss are pretty good, because you have other different factors that are working in your favor. And it's a pretty good entry point in euro dollar. Like 117, 118 isn't horrible to be short.
Yeah,
So
I
I
agree.
think as a dollar bull or a dollar bear, you kind of have some decent choices.
You know what's interesting is that kind of matches the equity market, where there's spots that are really good and there's
Mm,
spots that are death. You know what I mean? Like the middle tied to cyclical GDP is rough. If you're in the CapEx fire hose of the AI trade, it's the best time. It's 1999, it really is. It's harder to be full macro right now. It's
right.
definitely.
So if you're, yeah, you
Never
can't
go
really
total
say,
macro, guys. Never go
yeah,
total
yeah,
macro.
macro is dead. Long live macro. So like, yeah, you can't really be like, tell me what the stock market's doing, because it's just doing all kinds of shit. And you
Yeah.
can't really say like, tell me what the dollar's going to do, because again, it's kind of like there's no monolithic dollar trade and there's no monolithic stock market trade. Like obviously the indexes go up a lot when tech goes up. So there's an index trade, I guess, in theory, but really like, yeah, if you're looking at like IGV versus semis or whatever, those are the kind of trades that people are doing that are making money in on a trading kind of time horizon.
Yeah, the IGV
Just
is one I went long the IGV and short the semis, and I did okay in then February. Got my ass handed me in short semis in April. That was not the place to be at
Yeah,
all.
the semis thing is interesting because if you look at like DRAM prices and SanDisk, they've kind of like after ChatGPT September 2025, DRAM started going crazy. And DRAM prices have been flatlining for like 6 months, but the semis keep on going up, which like I guess now they're responding to earnings, but the earnings are kind of lagged response to the appreciation in DRAM prices. So I don't know. I feel like maybe overall in the market, momentum is doing a little bit too much work right now. And I think that's a risk. And like, if you look at recently, there's been some commentary of like semis and energy is the new 60/40. And whenever I see like XYZ is the new 60/40, I just want to short whatever that thing is. Cause like, no, it's not. It's not the new 60/40. Like you're extrapolating.
We have that actually. We have the from your notes. Your
Okay, yeah.
AMFX.
So I was talking about that. So essentially, you've had two wars which had a significant impact on energy. And right when the first war stopped having an impact on energy, ChatGPT was launched and semis went apeshit. So you kind of have like the perfect handoff from XLE to semis to back to XLE and now back to semis. So like I don't think as an investor you should be looking at that and saying like, hey, I want to be long this thing that just went up exponentially. Even though it kind of feels right now because you're kind of hedged for the war or whatever. But yeah, I hate it.
Yeah, I kind of only got one half of that memo. But just before we leave, the dollar as a sort of headline topic, I mean, do you believe that the sort of classic dollar smile is something in the rearview mirror, or are we going to be coming back to those kind of relationships in macro again?
So part of the thesis or like part of the framework I think still is valid, which is kind of what I said before, which is when there are attractive places around the world to put your money, which is usually the right-hand side of the dollar smile, good global growth and positive things going on in Europe or whatever. I feel like that part of the smile is still valid. So, when the US is outperforming, dollar rallies. When the rest of the world looks better, you buy foreign assets. But on the left-hand side of the dollar smile, I think it's a little bit overfit to 2008 because if you look at like, okay, all the major kind of risk aversion. So just for anyone that's listening or watching that doesn't know what that is, the dollar smile is like when the US is doing well, dollar goes up. And when the shit's hitting the fan, the dollar goes up because the dollar is a safe haven. But if you look at what has happened, like 2000, 2001, the dollar went down because everyone was massively overinvested in the US. Equities went down, so the dollar went down. Then in 08, everyone was massively short dollars, including foreign liability people like Mexico and Bradesco and all those people. So everyone was lending in dollars and the market was massively short dollars. It was like the biggest carry trade basically ever. So when the shit hit the fan, the dollar ripped. Then you can have other episodes in there. So like even more recently, April 2025, market was super long dollars because it was going to be fiscal, Trump, red wave, you know, all the good things. Tariffs are bullish dollar was the thesis as well. So everyone was long dollars. The shit hits the fan and the dollar sold off 10% in 1 month. And then more recently, when the war happened, you know, everyone was short dollars. So when the war happened, the dollar rallied. So to me, the left-hand side of the dollar smile, or in other words, like what happens when massive risk aversion or a shock hits, that whole thing is just predicated on positioning. So if the market's short dollars and a bad thing happens, the dollar is going to rally. And if the market's long dollars and the bad thing happens, the market sells dollars, simply because people degross and get closer to home when they're scared. So I don't think the left part of the dollar smile was really ever a thing. I think it's like overfit on 2008.
I mean, to be fair though, like, you know, late January through March, the dollar had, and now not a huge move, but it did definitely rally from like 95, 96 up to like 100, just using the DXY as a proxy.
Yeah, but I think that's because everyone was short dollars by that point because
Yeah, that's
of
fair.
the,
That's fair.
you know, Liberation Day and U.S.'s end of hegemony. And there was even like, you know, the European pension fund rebalancing story and all that. So I feel like by the time the war started, or even like early, whenever that started in February, the market was quite bearish dollar at that point.
Or at least like I have a chart that I don't have with us now, but like I like to monitor like the put skew on that, and it kind of lines up pretty well with spot. You know,
yeah,
a lot of
I mean,
hedging.
we have like our positioning indicator has 6 inputs and 2 of them are options skew, basically, because you generally, like, all of these things, like they all follow the price, but option skew actually doesn't always follow the price, and sometimes it moves more or moves first or moves, you know, in a different way. So I think it's a good indicator for sure.
So sticking on the FX, let's go to the since it's Golden Week and the Ministry of Finance decided to have a little fun. You know, they kept those boys in the office, and we had the bigger, like, we have, you were talking about it in your note. You know, we hit that 160 wall and refunded again, or rechecked.
Look at that slide! Holy God! So yeah, the interesting thing about this dollar yen intervention is, you know, like I've been watching these interventions since 1998, and I would say there's maybe one tiny exception, like in 2003, but basically the conditions are always substantial move in the currency, like strong or weak, and a breach of a major level, usually like an all-time low or high or whatever, and that's when they intervene. So there's a speed and a level condition. But this time we broke 160 in dollar yen, which was the level condition, but nothing was really going on. It wasn't going up that fast. There was nothing like really scary happening. And yet still the MOF came in and intervened. So I think that's a really interesting dynamic. It's a risky move for the central bank to try to, like, they're not exactly defending a level, but it definitely feels like they are, like they're responding to a breach of 160. And that's a risky play, as we saw with the SNB, because if macro doesn't cooperate, then you have a problem the next time it gets up there because you start losing credibility. So essentially what they're trying to do is buy some time until hopefully oil comes off, or US rates come off, or global rates come off, and then dollar yen can come off organically. But they can't make dollar yen go to 120, nor do they want that to happen. So it's kind of a weird situation where it's like dollar yen can't go up, but there's still tons of buyers because oil's still high. The oil importers still have to buy. And the BOJ is still running like deeply negative real rates. So the macro conditions aren't really there for like dollar yen to collapse. And like really they don't want it to. So what they want is like dollar yen to just be 157 for like 2 years. But you know, they obviously they're not necessarily
pulled that off they pulled that off for God knows how long this year.
Well, yeah. I mean, this is where spot is the same as it was in 2022. So in some way, you know, they are succeeding because they intervened in 2022, they intervened in 2024. And I mean, we went way lower. Obviously, we went to 135 after those interventions, but here we are again. Yeah, it's a tricky one for them. It's hard to trade because
we got a slide on the analogs, which I think.
Yeah.
Oh, right.
I remember on our chat on Bloomberg, you had put out the, you know, it came out because like everybody doesn't do anything after the first intervention because they're waiting for the second bop on the head, right? Isn't it like the market's like Pavlovian conditioned for that now?
Yeah, and it's so like it's always the same thing. They get it about 3% lower, and then it always hits a brick wall. There's just something about FX that it's hard to move dollar yen more than like 3%. And they're doing obviously a lot. They did like $34 billion, but you know, moving it more than 3-4% is just really difficult because people don't like, people know that you're not going to do that every day. You're not going to do 34 yards a day. So once you blow your 34 yards of dollar selling, you know, a lot of people are going to take the other side, including people that made money. I mean, they said the final warning at 159.50 and then they intervened half an hour later. So a lot of people made a lot of money on that.
But when you look at this is exactly what they want though, right? They want to see, hey, it's about half up, half down, about the same degree, right? So you can't, because they don't want to be gamed in essence.
Yeah, I know exactly. They just want to, basically they don't want it to go into free. They don't want the yen to go into free fall. And the interesting thing now is it's not like in response to this MOF move, everyone's gone like max short dollar yen. In fact, like I would say about 2/3 of our clients are bullish dollar yen still. They just think like oil's higher for longer, BOJ's crazy pills, and you know, this nothing stops the train kind of thing. I have a lot of respect for the MOF. I mean, most of their interventions worked, although not necessarily right away, but they also got a lot of help from macro, obviously, in 2012.
What's yours and what's your clients' take on the prospect for capital repatriation into Japan? Because you know it's not just the MOF, but Japan Inc. has a lot of firepower to see the yen stronger.
Yeah, that's the one thing that's kind of been missing from this is like all they have to do is, which is what they did in 2012, right? Is change the allocation of GPIF to buy more domestic assets. And I honestly don't understand why they haven't done that. I mean, JGB yields are high enough. They want to cap JGB yields. The easiest way to do it is just, you know, they control trillions of dollars of money with Campo and GPIF and all that. I don't really know why they haven't done it other than, you know, it's a pretty slow moving bureaucracy and that's requires a lot of work in the back end, I guess. But yeah, to me, it makes sense that they would, at least on the bond side, maybe not on the equity side, but on the bond side, just say like, hey, JGBs are yielding 3%. You know, why not switch out of Germany into domestic debt and then just make sure that you have the MOF at your back and you can't lose. But I don't know. I don't know why they haven't done that.
That's a complete head scratcher for me. I mean, their neighbors over the sea there in Korea have taken steps to sort of, if you like, trigger repatriation of capital with that Christmas or Boxing Day tax change. One of the big head scratchers for me has been, Brent, how I'm going to put this slide up here, and this is just the EWY. So the Kospi in dollars, the candles versus the won, and this relationship which has been a head scratcher for many of us, right? You've got active, you know, capital repatriation steps being taken by the Korean government and the Bank of Korea, and yet, you know, the currency can't find a bid when their equities are being adored.
Yeah, that's a strange thing. I think part of it is that when Korean equities are doing well, Korean retail feels bullish and they buy a lot of US tech. So I think that's part of it, is like Korea buying US is a much bigger, like not necessarily flow size, but like obviously US markets are so much bigger than Korean markets that Korean money can flow into the US more easily than, you know, there's a limit to how much US money can go into Korea.
Until recently, I tell you what,
yeah.
my DGen clients are super excited about interactive brokers change.
Yeah, but it is a bit of a puzzle for sure. People like in our client base have tried the trade a bunch of times. People are in the trade now. I mean, the carry's not that great. I mean, is part of the problem, but like it's not great in dollar China, and everyone loves trading dollar China, which is like a two vol currency most of the time. So yeah, that is a bit, definitely a head scratcher. It's one of those things where I feel like at some point, if the thing doesn't do what you kind of think it should be doing based on whatever framework, that the framework is wrong. And then, you know, can you find a framework that is right? I don't know. But to me, that framework of like Korea semis are good, so we got to buy the currency. It just like hasn't been a good framework. So same as like Swiss carry is negative, or Swiss carry is like Swiss rates are 0, so you got to be short Swiss. Like again, it should make sense, but there's other factors like current account and stuff like that with the franc.
What do you think about the idea that there's this massive net negative investment position in the U.S., which means everybody else in the world is long U.S., and then you think about like what happened with Taiwan last year, and then you think about what we're talking about here with Korean won. I mean, is there some worry about having to hedge back? I mean, do you think that that's playing into this?
Yeah, I mean, I guess that's part of it. I feel like that whole like negative investment position thing is like an interesting academic exercise, but like Jim Bianco was telling me in 1985, his boss turned to him at one point and there was a headline, US becomes net credit debtor for the first time ever. And his boss turned to him and said, dude, the dollar is fucked. There's no, like, because of all the same things that we say right now, which is like, there's no way to fund the current account deficit. And like, honestly, I just always think of the dollar as a cyclical thing. Like I don't find that any kind of structural analysis of like, central bank reserves going from 62% to 58% and all that stuff. I just don't find it. There's a way to make money off of it. Like the cyclical stuff the structural stuff might like create an asymmetry where the dollar could sell off more aggressively if the cyclical stuff lines up. But I don't feel like on its own, it really means anything. And I think a good example of that is like 2001, 2002, all the way to 2007. You did have like a massive dollar sell-off, and all the dreams of those sort of like negative investment position people kind of came true for a bunch of years. But you also had like a massive cyclical thing, and everyone had invested in the US in 99, and then everyone got out for 3-4 years straight during the bear market, right as China got added to WTO and all that. So I feel like looking at that structural stuff, you're always going to be bearish dollar. It's like looking at Tesla and saying, compared to Volkswagen, it's massively overvalued because of discounted cash flow analysis or whatever. It's just like, then you're always going to be short Tesla. I feel like it's one of those mismatch framework kind of things that it's more like for the economists to talk about, but you can't make money off of it.
Yeah, and being the reserve, I mean, one of my views as being the dollar bull is like, you can't think of it like in normal supply and demand terms the way we like to. It's like the dollar's the network, right? And so, it's 2/3 of global debt is dollar denominated or something like that. And so it's not about, the natural, is it in supply and in demand? There's some of that, and your trading horizon for sure, there's some of that. But like a lot of it's like every year there's $10 billion of interest that needs to be paid in dollars. That's 10% of global GDP. That has nothing to do with anything, right? And so,
it's like a great example of that is that crypto was supposed to be like the replacement for the dollar. At one point, that was like, of the 25 narratives or whatever, that was one of the ones that was like a big narrative for a while. And yet what actually happened was crypto just became another layer of the dollar system, because the dollar system is so powerful that like no one's issuing stable coins in yen, because like that's just not a thing that anyone would actually want to use to transact. So the crypto actually ended up reinforcing the dollar as like the primary layer of the global financial system. And so, yeah, I think there's a lot to be said for that, is that, like what's backing it? Well, like military, innovation, all that stuff is backing it. Sure, like there's no physical gold backing it, the thing anymore, but there's a lot of, whatever you want to call it, military
inertia, right? There's an inertia.
Yeah.
How do you unwind it? Like you're just not going to unwind these things overnight in some new usurper called Bitcoin, or even if it's stable, whatever. So yeah.
And it's same with the whole CNY, like different dollar system. Oh, we're going to pay in yuan or whatever. That thing's gone from 1% to 5% or whatever of global payments. It's a thing, but it's just like, it's not tradable on any time horizon, I don't think.
We agree. So, one of the things you talked about recently, and we put a little slide up here for you, sometimes you don't have to have a view. And so, can you explain to our listeners, what an iron condor is? You know who loves iron condors? Option dealers. They love iron condors.
Yeah,
there's Captain Condor in the Spoos. There's Captain Condor in the Spoos complex, right? They love them in Chicago.
They're a pain in the ass to book too if you have to book manually because there's 4 legs. But these slides are absolutely gorgeous. So I think that the kind of like main point of this exercise that I wrote about, which is that slide, the dollar Swiss slide, was not so much to say, hey, everybody do iron condors in FX, but more that I feel like one thing I've learned over the years is that you can't just be the one trick pony. Like, I'm a directional macro guy, so I'm just only going to buy and sell dollars and watch it go up 10%. It just like things aren't always like working that way. So I feel like the ability to have a lot of different structures in your head, like long vol structures, short vol structures, or like it's going to go down fast and then it's going to stabilize that structure. All those different structures give you a way to make money in different regimes, because what I was for like the first 15 years of my career was directional macro, and essentially my P&L and volatility were so highly correlated that it took me a few years of collecting data, but then you look and it's like, okay, when VIX is above 20, I make money. When VIX is above 40, like I print money. And when VIX is 12, like I lose money, like I grind, and I basically like I'm long vol. That's exactly what it looks like. Like it goes up and then it bleeds all the way down. And so finding ways to make money in different regimes, I think, is really important, like especially in FX, because sometimes FX is just nowhere for 6 months, 8 months. And then if you can be long, if you can recognize that, which is the hard part, and then be long carry, so doing an iron condor is like basically just saying like, hey, I don't think this thing's going anywhere, so I'm going to create a range outside of which I don't think we're going to go, and then and a time horizon, and then I'm going to sell options, but I'm also going to limit my downside, because one thing I just don't believe in is like unlimited downside structures of any type. Like psychologically, it's bad. It's hard to sleep. It's kind of nerve-wracking, but also like you're just exposing yourself to blowing up and losing your job. And I don't want to lose my job ever, or blow up my own account. We all
remember Everest and the Swiss franc.
Yeah, right? I mean, there's so many of those, and it's a lot of like, it's not just like random retail people with 50 grand in their account blowing up, like Bill Wong, Plotkin, whatever. I'm sure Plotkin's fine. He owns a basketball team, but like there's something to be said for just every morning, whatever trade you put on, saying, I'm not going to blow up no matter what, no matter how good the thing looks. I'm always going to have some protection. So iron condor is like selling vol, but with protection. And, in that example, it worked out well. I think I got a bit lucky at the end, but what
that was a dream close.
It was, yeah.
Plunged in between your strikes.
And the other thing about those things,
the other thing about these multi-leg structures, Brent, is that they give you extra optionality if the regime suddenly shifts on you, because you've got 4 legs to play with. Now, you're not going to open up, risk to the extreme either way, but you do have more levers to play with if the regime suddenly shifts on you.
Yeah, you can always just take off the short leg or whatever you want to do. And the other thing about this is that I feel like generally people are mostly always long vol. And so if you're a directional macro hedge fund person, you are already implicitly long vol. Like the more things happen, it's just better for your book. So adding more long vol by buying vol all the time isn't always the answer. And, I learned that when I was running the spot desk at Citibank, which Rupert, you worked there as well. You would notice that like in low vol periods, we all would be decaying because we'd all be long options, and the franchise wouldn't be bringing in much volume because nothing was going on. And it's like, oh, this is kind of stupid. Like we're synthetically long vol via the franchise, and then we're like actually long vol via options. So then we started selling one touches, and that was a much better strategy. Like, and then of course, like if you have a reason to think vol is going to go up, you still buy vol. But I think it all comes back to that, like, don't be a one-trick pony thing of like, don't be a breakout trader, don't be a vol owner, don't be a vol seller necessarily, you know, like even if your system is to sell vol, like some of the best traders that I've worked with were basically always long EM and mostly short vol. But once in a while they just say, you know what, this is wrong. Some like the shit's hitting the fan. It's February 2020 or whatever the thing is, you know, or like this central bank has spoken in Brazil and I don't want to, you know, just sit here long Brazil because my model says I'm supposed to be. So I think the more you spend time in the markets, I think the more you can add different strategies, especially if you're really good in one product, then you can like add more strategies and structures while still being good at that product. As opposed to like, I'm really good in FX, so now I'm going to become a rates expert. Like, I feel like that's way, way harder. Whereas being good in FX and then moving beyond just vanilla structures, I think is a lot more feasible.
You know,
So
it's
can
funny
we?
because you want to go?
Go on, Benny. I was going to slightly switch gears. So
I started my career after grad school at Fidelity, you know, plain vanilla guys there, and I was always more macro, but they weren't trying to hire a macro strategist right out of grad school. And I didn't want to work in credit in the middle of the 2000s. I knew what was coming. And but it's funny because like some of those guys go on to be long short guys, and I think they only think about it from a long short perspective and don't realize that they're implicitly kind of short vol, and you know they can get hit short vol on both sides. And you would think that more people would like be like, hey, I don't need to become a different market. I just need to learn how to like expand my portfolio of moves, you know, on a, you know, I was a basketball player, so I can expand my game within the game I play. You know, why?
Right.
Yeah, like why do you think that's not like more prevalent?
I think part of it, so there's one part which is the mandate, right? So like if you're the spot trader at Citibank, they're not really too excited about you selling Brazil iron condors or whatever, you know. So some of it is just mandate. Like if you work at a long short fund or whatever, that's probably your mandate. But outside of that, I think part of it is just, whoops, I'm going off the screen. Part of it is like just a lack of creativity, I think, is that, you know, Wall Street attracts a lot of people who are super smart, mostly quantitative, but it's not really selecting for creativity that much. So I think a lot of people just come in and, you know, they're really good at the thing and they just keep on doing it. And the thought doesn't enter their mind of like, oh, why don't I do some other thing? Whereas like, you know, if you're a different kind of person that like, you know, is addicted to change and novelty and all, you know, that kind of thing, you're more likely to bounce around. So that's more like my personality type. So I think that's part of it, is just people get good at something and you know, don't see any reason, like if it ain't broke, don't fix it kind of thing. And I honestly, I think a lot of people just don't even think of it. It's just like, hey, I'm a spot FX trader. Why would I be doing options? You know, I think that's
or
a
in
lot
Rupert's case, I'm an IPO banker. I do IPOs. Bring them on.
Right. So
well, I mean, I'm a celebrator of the generalist generally, because I often think that a fresh pair of eyes can bring something new and fresh to a new to the specialists that only look at one thing. You know, everything looks like a nail if you're a hammer. So come along with a screwdriver occasionally.
That's the hedgehog and the fox or whatever. That's kind of like the debate of, is it better to specialize? And I think like initially it's much better to specialize when you come into markets. And then as you generalize, the thing that you're specializing in, you get better at. So like, that's one thing I found because I always worked at banks. When I went to a hedge fund, I was allowed to trade crude and futures and all this stuff. And I was like, woo, kid in a candy store. And whether I made money in futures, like I didn't trade the same size. So I barely made any money in futures, but I learned so much from doing it that I became a way better FX trader. Cause then when like, you know, NYMEX crude spikes at 2:30 p.m. and there's a strong correlation to CAD, you know, like, okay, that move's bullshit because it's just like a market on close order or whatever, you know, that kind of thing. So
you wrote about this. You wrote about this so well in your first book, actually, in terms of traditional cross asset relationships. But
I mean, that's a perfect segue, because you know you had this in one of your notes. I mean, your dollar looks a lot like that crude chart right there, huh? Inverted.
Yeah, you know, I actually was working on Friday speed run just now, and I was looking at a chart of Brent crude and German 2-year yields, and it's like the 5-minute chart for the last 4 weeks is like perfectly tick for tick as well. That's kind of part of why like macro is dead right now, because if you're a rates trader, like what are you predicting what the ECB's going to do based on what? Based on the price of oil. Like there's no other inputs
They're
right
all
now.
they're all oil trades now, which is annoying as a
Yeah,
guy's gotten his face ripped off long SOFRs recently. Like,
right. Yeah.
yeah,
So there's no way to escape that. Like everything's kind of all about oil right now. It's similar to like, it's weird though, because it's different, but it's similar to 2008, where like I could wake up in the morning and look at S&Ps and I could tell you where like Aussie bonds, dollar yen, I could just tell you where everything was going to be because it was so perfectly correlated. But usually that like 1.0 correlation, like tick for tick, is a feature of like panic sort of like liquidation kind of markets. But this isn't that at all. Like VIX is at 17, stocks are at the all-time highs, but yet rates and oil are still like and euro dollar are all just tracking each other perfectly. So in that case, you got to have a view on oil or on geopolitics, or just trade mean reversion or trade something else.
So as CIO of Magazine Capital LLC, are you worried about putting this one on?
You know what? I feel like, let me just very quickly explain if people don't know what you're talking about, but I systematically fade all the economist covers that are directional for an asset. And it's basically because once it's on the cover of the Economist, it means it's very late in the narrative cycle. And the hit rate is like 65% over 6 months. And there's a huge positive skew to the returns because it tends to either keep going a bit, like what the Economist said, or reverse a lot. But to answer your question, when I would say like 70% of these trades, I absolutely hate them when I put them on, because it's so the thing that's going on. So, and you're fading like the biggest narrative in the world. But that's the whole point, right? So like if it was comfortable, then it probably wouldn't make money. And I feel like it's similar to like after, say stocks have been going down for 4 months, and I'm like, I don't know, I got all my reasons and I'm bullish, and I'm about to publish my thing. And I'm like, oh, I feel so uncomfortable. People are going to hate me so much for saying this, because I know everyone's like going to disagree with me. And those are the points when, you know, it's probably a great idea. So yeah, I basically I would say I hate like 70% of them. And like short crude, I guess I'm kind of neutral in terms of my own view on that. Like I could see like we basically just had like the end of the world scenario. Every expert was saying like if Strait of Hormuz closes, the world is going to end. There'll be no helium and no corn, you know, like kind of thing. And now we're 10 weeks into a 4-week war. And like, as far as I can tell, this like the shelves are still stocked at Walmart. And like, you know, Australia didn't run out of gasoline that I've heard, you know, whereas like 2 weeks into this thing, people are like, we're going to have a massive supply shock on the level of COVID. So I don't know. I don't hate being short crude, but it's the biggest problem is just like all the headline risk is really hard to manage. In these environments, like you either got to trade headlines themselves, mean reversion, or you got to have your view and your levels and just say like, I don't care what headline comes out. I'm short oil until 124 trades. And I'm not even going to look at the headlines, because otherwise you just get chopped up chasing everything all over the place.
And headlines are kind of hard, you know, as over the last 15 years, 20 years of running books, like you could see the algos come in, like they got much faster and it would spike. And now with the LLMs, and maybe we can talk about that a little bit, because I'm co-founder of an AI company and I've done a lot of research on the impact of LLMs. I know you talked about this. Is like you almost have to be contra to the headlines at this point, right? Like me and you and the squirrel aren't beating the algos to it, are we?
Yeah. So there's kind of two levels of it for me. So the first level is exactly what you said, which is most of those algos have pretty small risk limits and tight stops. So the best trade that you're just like of the type you're describing is like Bloomberg red headline, and then you read the thing quickly and it's like the red headline was not even really what the thing is, you know, like it was a massive exaggeration, and then you fade it, and then the algos all stop out and you make 30 pips in euro or whatever. And then the other level is like no amount of movement in the first 2 minutes can possibly, be account for how big this headline is. Like Liberation Day, dollar yen was down 140 pips or something pretty quick. And people were saying to me like, oh, I missed it. It's gone down too much. And it went down like 600 points more in like the next 48 hours or whatever. So like, to me, you got to like make a judgment. Like, so 90% of them not tradable because the algos just got it. And it was they're probably tuned correctly to the headline. And then some percentage of them that the headline isn't actually what it sounds like, or it's not as important as the algos thought it was. And then some small percent, no amount of algo risk limits can possibly buy enough for this headline because it's so big, kind of thing. So that's how I look at it. But most of that's been true for a long time. Like the LLMs make the algos better, but the fundamental microstructure issue really has been around for 10 years, like of just like, it's a really hard to trade headlines.
Do you think the algos and this is my bully pulpit topic, which is, I've already named the show, by the way, FX Vol, the dog that didn't bark. I mean, it's something that Ben and I have talked about a bit in that, do you think that the algos are contributing to this sort of, dearth of volatility in FX land, when we've seen moments of credit vol, we've seen moments of equity vol, but really, we've seen rates vol, but what FX vol's just kind of done nothing for 5 years.
Yeah, I mean, I would say at the margin, yes. But I think the bigger problem has just been that there's no idiosyncratic economic story by country since COVID. Like COVID was a global story. Rate normalization. I mean, if you plot like what the central banks did, they all basically started hiking at the same time. They all hiked the same 500 basis points and they all stopped at the same time. So I feel like if you believe that interest rate differentials are like usually the number one driver of FX, and the central banks have been coordinated through like during and post COVID, not explicitly coordinated, but just they have been coordinated, then I think that explains more of it. Because like algos, they really started, like the market making ones came in like 2005. So I don't know. I feel like algos are part of the microstructure, just like 0-day expiry options are part of the microstructure, and they change, the intraday behavior and stuff like that. But I don't think like 1 month euro dollar vol is dampened by anything that algos are doing. I think intraday weirdness and stuff matters microstructure wise, but I think FX is still a pretty macro. If you had the Fed starting to hike, the dollar will probably go up, and algos aren't going to stop it, if that makes any sense.
Yeah, it makes perfect sense. Makes perfect sense. Yeah, I mean, I mean, actually, the coordination is probably, as you say, the big thing that's underlying this sort of calmness. What's it take to break it, right? I mean, we're seeing a little bit of synchronicity being lost between the global central banks now.
Yeah, I mean, I think that's ultimately what you need is like a Fed. I mean, you sort of like are on the front edge of it. Like a Fed is not going to hike and everyone else hikes kind of cycle. But then, like we were saying earlier in the show, the tech thing is dampening that, unfortunately. So you have like the real thing that would increase FX vol would be like Fed starts hiking, bond market vol goes up, and dollar starts ripping. And then I think that would be super bullish FX vol. But right now it's like you have too many things going in opposite directions. So I guess my answer would be if the market starts pricing Fed hikes, then I would buy FX vol for sure on that.
Yeah. Do you think about it more from like a catalyst fundamental standpoint, or do you, when a friend of the show, my buddy David Dredge, big FX vol guy out in Singapore, and he treats it as like, hey, a value investor would, hey, this is a 7p stock. I don't know when it's going to work, but I'm going to make money on it at some point, because even those charts we showed, there's periodic spike ups. Now monetizing it as a guy who longs a vol fund, I can tell you that is the hard part of being long vol.
Yeah, I don't think that way at all. Just simply because it doesn't fit my time horizon. And also I made the mistake, maybe this is like overlearning a mistake that isn't totally applicable, but I made the mistake for a long time in the 2000s of like anytime VIX got to 12, I'd just be bearish stocks because like VIX can't go down anymore. But you know what can happen is realized can go way below implied, and you just get screwed for month after month. So for me, like what I'm usually looking for is like events that I feel like I appreciate more than the market does. Or like say like this is not an example of one I believe, but an example of one I could would be like local elections in the UK this weekend. Nobody really seems to care. Vol's pretty cheap. You can probably buy 1 week at a reasonable price in euro sterling. So like if I have a differential view on like a catalyst or something like that, but really I don't trade vol as an asset class. So like I'm always trading like, okay, I'm risking X to make Y, whether I'm buying or selling vol. That's just how I think of it. So I'm always thinking more in terms of like risk units and not like, oh, I love 3-month euro vol at 6 and I'm going to like trade the gamma or whatever. That's just not like, it's that there's sort of a line, like, cause earlier we were talking about like varying your structures and being creative, but there is a line where you go like, that's too hard. That's not what I do. And so like trading vol as an asset class or like trading sturt, like front end rates, I just feel like I'm never going to be better than the experts at that, especially those two specifically are like populated by super quanti, super talented people. So I'm never going to like out edge those people. And so I'm always thinking like, okay, I'm bearish Aussie. Now I can do spot. I could, sell top side. I can buy downside. I could buy put spreads. Like I'll think of all the 20 different structures. But I'll never be like, okay, I like Aussie vol, so I'm going to buy like, or do FVAs or anything like that.
Do you now, especially with the advent of LLMs, come back to it, you have a view, like, some signal comes in your brain. You've been doing this a long time. So let's say you have a long context window. Do you then like put it through of like, here's what the different structures are and here's what I could do, and then think about it like systematically, or you just kind of all the muscle memories there in your head and you kind of like evaluate it? Like, what's the process of that?
So that's funny that you say that, because that's something in my new book, which is how I use LLMs in general. But one of the subtopics is using them for trade structuring, because I feel like so when I was trading FX at banks, and Spectra was a broker of mine, so I did not work for Spectra at that time. I mostly just outsourced it to the guy who I know at Spectra who's really good. And I would say, I think Aussie's going to 70, but I don't think it's going to go to 69. So, what's the best structure? I think it's going to happen over the next 3 weeks. And he would say, oh, do this because, or whatever. And half the time just be like, dude, buy vanillas. But so I don't feel like I'm like a leading global expert in trade structuring. Like I'm way better than I used to be. So I use LLMs exactly for that. So I'll say like, CoreWeave, there's no borrow and I want to be short. This is not my view right now. This is ages ago. But like, give me 3 different ways I could be short CoreWeave with limited downside, taking into account that it's hard to borrow, expensive to borrow. So that'll factor into the puts or whatever. And I do find actually the answers are good. Like the corpus, or what did you call it? The look back, what did you call that?
Context window.
Yeah, the context.
Sorry, the more I'm in AI and start talking like an engineer, it's annoying. I apologize.
No, it sounded cool, so I wanted to replicate it. But the amount of information that is online or in those LLMs about option structuring and stuff is like massive, right? So I find it's really good for that. Like just saying a detailed view and saying, how should I structure it? Like I would say like 8 times out of 10, it's like, yeah, okay, that's what I expected. But sometimes I'll be like, oh yeah, that's actually, I never thought of that. So yeah, I think they're good for that.
Yeah, great. And another thing you talked about in your book, and we're going to get to it in a second, I just want to get this one, was shorting is the worst thing ever. And as a guy who's done too much shorting in his life, I will fully attest to that.
Yeah, I think I never fully appreciated that for like the first 15 years of my career of, I could go through all the things like it is in the book. And not because I don't want to spoil it, just like I don't want to be boring, but like obviously puts are usually overpriced because of the skew. There's always natural buyers of puts, but not as many natural buyers of calls. And I mean, that's not as true now. You're paying for the borrow. It's sometimes difficult to borrow the things you most want to short. the most desirable things to short have the worst convexity because everyone's short, but also they have the worst performance. So you do want to be short those things. Like the hardest to borrow stocks are the worst performing stocks, but also the scariest to be short. And there's so many things. Your position gets bigger when you're wrong instead of getting smaller. All those things. So you're more likely to get margin called. You're more likely to just have like a massive position that you didn't really want to have a massive position. If you're shorting Avis at 200 and now it's at 800, you have 4 times as much risk, but you didn't really want to have that. So, and then there's the positive drift, stocks pay dividends, stocks, GDP grows, population grows. You're just fighting like so many things that are mathematically challenging for being short, but then it's so much fun when it works. And like, there's a time and a place for it, right? Like it's, and I traded 2008, like it was like, felt like free money being short half the time, although not on Tuesdays, not in the afternoon. Yeah. But, so I feel like for me, I always think of shorts as like opportunistic. I'm always thinking of like, where am I going to get out of my short? Even when I first put it on, I'm already thinking like, okay, if this thing goes down, whatever, I'm out, and I try to stick to it. Because it's just it's so sexy and so much dopamine and cortisol when your shorts are working. But that's the exact reason that it doesn't work very long, is because you tend to like double down at the lows and all that stuff. So I've become much more disciplined about that, and also much more disciplined about just shorting with the stop instead of buying puts. Cause like, it's easy to be right and lose money buying puts. You're kind of playing for like the super exciting thing that never happens, instead of like being short cash. You can start, like, if you're short, like say you short SanDisk at 1321 because of XYZ, and it's like a 1 month view, but then it goes to 1180. You can start trading like your long gamma. You can buy back a quarter of your position, sell it on the bounce, and the thing's flying all over the place. Whereas puts, like you're paying a lot, like SanDisk puts, you obviously would have to buy so far out of the money to even buy something reasonable. And I don't feel like you're as flexible. The bid offer's wider. And just generally, like, I feel like the expected value is better. So I've migrated. And also I think it's just creates for me a more tactical mentality. Like if I'm buying 1 month puts on something, that just feels like a lazy trade. Like I'm just buying something and I'm hoping it collapses in the next month. And like, whereas if I'm short, I'm like tuned into the thing I'm watching. I probably have level 2 up. I know where my stop is, and I'm just like a lot more nimble. And then when it drops $40, I'm okay to take 25% off. I'm not looking, like, basically I'm not looking for home runs all the time. And I'll always be willing to flip long. So yeah, just shorting is hard. Everything is stacked against you, but I still short all the time, and I just try not to. Also, the other thing, which I'm sure you guys have learned, is like the ecosystem of financial information. You get so many more clicks when you're bearish, and so everything is skewed bearish in the media because that's how they get clicks. And that's more like intellectually, it's a smarter sounding thing to write bearish stuff. When you're writing bullish stuff, you sound like a cheerleader or whatever. That's what Morgan Housel says. So I feel like I also try to manage my diet of media and like make sure I subscribe to bullish people just to have like a proper, properly balanced diet of content, because there's so many smart people that have been bearish since literally there's some guys that are well known that still publish bearish stuff that have been bearish since 2010. And it's like, what are we doing here? Like, that's not, your framework is wrong. Like at some point you just have to say, like, and that's the thing that for me, it's just so easy. Like I have no switching costs. So I know it's like, I have an advantage in that. I don't care if I was bearish yesterday, I can be bullish tomorrow. I just truly don't care. But like at some point you go, okay, yeah, Tesla's market cap seems really high. And 5 years later, you're still saying Tesla's market cap seems really high. That means your framework's wrong. Like it doesn't mean Tesla's market cap.
Let's talk about framework, because it's a great segue into the new book. Whoop, what happened to that? There you go. There we go. So we have been well, we've been trying to sort of synthesize what you've been telling people, other people about the book. And I mean, as someone who read your first book, I know that this one is much more targeted at professionals opposed to Alpha Trader 1, which was targeted at anyone, at every man. So why don't we take it from there and talk about what you've added to the thought process and your overall process with it?
Sure. So I feel like Alpha Trader was a good book in that it kind of covers all the bases, and that was kind of my goal, was like cover all the aspects of trading, not just like trade selection, which a lot of books do, or not just psychology, which a lot of books do. But then now I wanted to have the freedom to just write a book that's more for professionals or experienced traders and go beyond. Like basically every trading book is fundamentals, technicals, behavioral, or quantitative. Those are like the four. So the thing, my new book's called Alpha Trader 2 Outside the Box, which is essentially the box formed by those four disciplines, trying to get outside of that. And like, I guess the core like elevator pitch is like, if you do the same thing as everyone else or think the same as everyone else, you'll perform like everyone else. And that's like a derogatory statement because, you know, the average investor and trader, you know, massively underperforms every single benchmark. So what I wanted to do was kind of like set an example of here's how I take stuff from other domains and apply it to trading so that other people can do the same thing. So, oh my God, these slides are beautiful. So looking at like clinical psychology, like addiction, all that kind of stuff, and then poker, I mean, it's all on the slide there. But different domains that I've incorporated into my thinking over time. And I feel like I've got a lot of edge from those things because, like, for example, you can only get so many reps in trading. And if your problem is over trading and gambling or whatever, then sitting at a poker table live where it's pretty slow, but it's still way, you know, you get way more reps than trading, or online poker, which is way faster. You can get a lot of reps and get into that mode of like being a robot. Like, you know, when I get 6 jack suited, you know, fold it, not play the hand because I'm bored and I want to have fun. So like there's different ways that you can apply outside things to trading. So that's kind of like the main idea. But then there's some other stuff that's newer, like how I use LLMs, which obviously that wasn't a thing in 2021 when I wrote Alpha Trader. And then trade structuring, which I felt was like just a little bit too advanced for a book that should be more a general book. So some of the things are more like that, about like ergodicity, which is just like fancy way of saying don't blow up essentially. But
sequencing, right? We've talked about that. Dredge talks about it all the time. We had a whole episode talking about it, you know?
It's like, and I think people underappreciate it. Like you see, I mean, hedge funds still blow up, and like some of that's moral hazard and people know what they're doing and blow up anyways, but some of it isn't. Some of it is just like people doing things that probably they shouldn't be doing. So just some of it is just different concepts that I've come to understand over time. Even the shorting thing that we talked about, like, I don't think, like, I've been trading since 1995. I don't think I really truly understood like how skewed the math is when you're shorting or when you're bearish till like 10 years ago, maybe or so. So like, I feel like I want to explain that to people and hopefully maybe save some people some money. So that's, I think we kind of covered the general thing. Is basically the box is all the trading books that you've ever read. And I'm trying to go outside that box and relay a little bit more advanced information for people who are already probably professional traders, but want to, you know, add new ways of thinking. Because like another kind of thing that I've realized only by being around for a long time is that like whatever you're doing to make money today is probably not the way you're making money in like 3 years or 4 years. Absolutely. So I want to cover that as well, and with some examples and stuff.
And regime shifts are collapsing. The windows of like what works can, like, I mean, this rally is a great example, like a 7% drawdown, and then we're just ripping the Nasdaq's up 25%. And I know some of it's the LM thing, but like, you know, one of the things that I've noticed in the research is LLMs and LPPLs, these algos, their memory is much lower, and they're an incrementally larger percentage of the discretionary, because our buddy Mike Green will tell you the passive is like they're just sitting there, they're not doing anything. And so they have more impact. Let's finish this off before we let you tell everyone you're out with this story. Because I, as a guy who's gotten caught short a few times, give us a little color on this.
Oh my God. So it was Friday afternoon and a headline came out and I knew nothing about sats. I didn't even know what the company was. It's EchoStar, which is like a, Dish Network and all that. And I know a lot about it now. So a headline came out. The stock was at like, I don't know, $20 or something. And a headline came out, EchoStar could file for bankruptcy given pressures on broadband license or something like that. And like, I didn't know what any of that meant, but the stock was trading at like still at $16. And as anyone would know, a stock normally when they announce possible bankruptcy is closer to zero than to 18. So I sold a bunch at like 11.50 and it was instantly 15. Like I sold below, basically it was probably trading 11.50, 17. I hit at 11.50. It was 15 bid, 16 bid. And I was like, this is weird. Like if they're potentially going bankrupt, how is it still trading at $16? This makes no sense. So long story short was it was a ploy that the CEO was making to try to get the politics on his side so that he could sell his broadband licenses. And so I covered at like, I don't know, 17, 18, 19. I held it for the weekend and then researched it. And I was like, oh shit, this is not a good short. But I think the all-time low is 15 in that whole window. But I managed to sell at 11.50 because it was like 6 p.m. on a Friday. So it doesn't register in the high-low. But then what happened after that was I kind of did like a deep dive on the company after that because I was like, I needed to know whether to keep this short or not. And then, so I had done like a bit of rough math, like they had 23 billion in debt, and a headline then came out like weeks later when that crazy spike happened. They sold like not all of their broadband. I think it was like 35% of their broadband for $23 billion. And it just coincidentally was like the exact amount of all their debt. And so because I knew all that stuff from before, I was able to buy it at like 42. And I don't know, I sold it way higher, like 65, 70 or something a couple of days later. But the lesson for me, I think, was, first of all, like, if you make a mistake, just cover it as soon as is reasonably, like maybe figure out if you did make a mistake, which, because I didn't know, but then cover it, like kind of don't try to like buy the dip back to 15, 20 or whatever, which is like, that would have been my instinct when I started, was like, oh, when it gets back to break even, I'll get out. But then also by like kind of using it as like not being too emotional about it. I did learn a lot about it. And then, when the news came out, I was able to just not care and be long the thing at 42, even though I was short at 11.50, and just kind of having that agnostic mentality of like, I'll be long or short the thing, whatever is going to make money, I'm happy to do it. And then also just learning from mistakes. And even like whenever something happens, like there's a thing in my book about, I misunderstood the CoreWeave buyout of what is it, CORZ? I forget what the company was. But anyways, after
the Bitcoin miner. Yeah.
Yeah, I can't remember the name of the company, but I lost a bunch of money on the trade. But again, I kind of, after reading all about it, I learned so much about the whole CoreWeave situation and stuff that I ended up making money on a different headline like 2 months later or whatever. So I feel like a lot of times you can kind of turn losses into like knowledge, and then that knowledge can pay off later, as opposed to like feeling emotionally devastated and, or not doing the work and then just waiting and getting stopped out at 22 or whatever. So yeah, that was the story. And I guess it's nothing to be proud of, but it's kind of neat when you sell below the all-time low, I guess.
But also the intellectual flexibility to go the other way is a true mark of,
it's useful.
Yeah, I mean, I find that so hard. I find that so hard. But Brent, this has been amazing. You have a gaming date with your 21-year-old son, so I want you to respect that. But just before you leave us, can you tell everybody where they can get hold of a copy of Alpha Trader 2 and when, and anything else you want to tell us?
Sure. So the book comes out in a couple of weeks, probably around May 22nd, and it'll be on Amazon.
My birthday. Oh, nice. my birthday present to myself. There you go. Thank you.
And everything that I do is at spectramarkets.com. So, the books are there, but then, my daily's there and everything's there. SPECTRA.
Perfect. Brent, thanks so much. Please join us again soon.
All right. Thanks for having me.
Thanks, buddy.
Thanks, Ben. All right.